Well, good afternoon, everybody, and welcome to the Tuesday, April the 9th, 2019 session in our series about entrepreneurship and Asian high-tech industries. I'm Richard Dasher. I direct the US-Asia Technology Management Center. We're very proud to be presenting this series in our 26th year of presenting these kinds of public seminars at Stanford. I would like to point out that the US-Asia Center is a membership-based industry affiliates organization, and so all of our support comes from member companies. We have 5 member companies right now, about to be 7 as soon as we get the next checks in. And so we hope that you'll get to meet the representatives of our companies, some of whom are here today. And we'll have some refreshments outside thanks to their support. And please stay around and get to know each other and talk more about the session and do some Silicon Valley style networking. So I'm happy to be able to present what's really a yearly talk. I give this Asia Entrepreneurship Update every year as part of the series. Usually I give it in the first week, but last week, as you know, I was in Tokyo with Tim Romero, who talked about the situation in Japan. That should be up on video soon if it is not already, so make sure you try to find the tape of that session if you were not here in person. This is going to be a weekly series. We'll run through May the 28th this year. You can always find out more information on our website. And what we're really trying to do is to bring information and insights about entrepreneurship and the supporting ecosystems around the major economies of East Asia. This is available for credit to Stanford students, but everyone is welcome. If you're taking the course for credit, make sure you get a copy of the syllabus because the requirements for this seminar are a little bit unusual. I ask each student to give me a weekly comment, and I usually reply directly to that weekly comment. So it gives me a chance to interact personally with every person who's taking the class. But that's a little different from the way a lot of seminars here work, so be careful. Anyway, where do you get started when you're talking about Asia? Money's a good place. So the total size of the world economy, world gross domestic product in 2018 was estimated to be about $134 trillion. And the largest single country economy in the world is China. The US comes in at number 2. Notice that there are 4 Asia countries in the top 10 largest economies in the world. And there are now 9 Asia countries that are all in what's called the $1 trillion club. Now, this is calculated at purchase power parity. If you use the real exchange rate you can get in a bank, the numbers would be very different. This is calculated on what you can buy with a particular amount of money or how much money it takes to buy a particular basket of goods. But it's a very good way to compare economies to see what you can actually do from one to the next. Now, one reason Asia is so interesting is because of graphs like this. This is the gross domestic product of China. This is the gross domestic product of the US. It was really about 2014 when China became the world's single largest economy. Notice that India is doing very well. India is also growing at a quite rapid rate. And Japan and Germany kind of round out the top 5 countries in the world with what you would call slow and steady. I think the Japanese don't like it very much. I haven't heard too much complaining about growth rates from the Germans, even though they're down around, 0.9% usually. The tigers. These used to be the jumping off places to China. The main reason to show this is so you get a sense of the relative size. South Korea is the biggest one in terms of the size of its economy. And then right after that, You have Taiwan, and you have Singapore and South Korea and Hong Kong, special administrative region. What most people are really not expecting is the next slide. In developing Asia, if you look at this same kind of growth pattern, look at Indonesia. People have really been missing the huge amount of economic power that has been created in Indonesia over the years. It's the largest population of any of the Southeast Asian countries, and it's by far the largest economy now. So when you have that kind of thing going on, people are always interested in what's coming ahead. And one of the big sort of things that people tend to look at more than these absolute numbers is the percentage of growth every year that an economy is experiencing. If you look at that, and unfortunately they don't do that in PPP, so this is in real GDP calculations, you see that the growth rate in China has slowed down considerably. You see a wide variation in what's going on in India. And you see this kind of, the world is cruising along at 3.7% for the last 4 years, or the last 2 years, and it predicted to stay about the same rate. And yet all of these major economies from Asia are growing a lot faster. Even as China slows, it was about 10% a year in as recently as 2014 or so, 2012, down to what is predicted to be 6.2% this year. 6.2% in an economy the size of China, in absolute terms, is a much bigger amount of economic output than you get with a much higher growth rate in a smaller economy. So this is one thing why China is still interesting to people, even though it's slowed down. But I think it's worth noting that the Chinese government is definitely taking actions that I see as, if not in response to, they are correlating with this slowdown. They're especially worried about the big infrastructure industries that really grew up in the last generation in China. Consumer spending became the main driver of the Chinese economy about 7 or 8 years ago. But what happened to all the infrastructure companies? Well, we have $150 billion invested by the Chinese government in the Belt and Road Initiative, so that this will actually help those companies to expand to global markets as their own domestic market slows down. We have a lot of international investment going on by private sector Chinese firms. We'll talk some more about that later in the economy. But I think rather than being something about innovation or entrepreneurship, that's global expansion. This is companies that are truly becoming multinational corporations. And that's a new thing for China. We've seen it in the Japanese and Korean companies for the last, somewhere between 50 and 20 years. But to really have multinational companies in China is kind of a new thing. Now, as an economy slows down, though, you expect more protectionism. And China has not opened up yet. The Chinese market is very difficult for a lot of foreign firms to get into. You can't see Facebook in China. This will be put on YouTube, but you will not see this on YouTube in China unless you use some sort of a dodgy, VPN that you might get in trouble for. And so there's a lot of things that are unresolved about China. I'm not going to get into that too much today, but it's a real wild card. We really don't know how it's going to play out. One thing you can see is that the patterns of growth that are leading to these high economic growth patterns really reflect the new spending patterns of an emerging middle class. And this is characteristic not only in China, it's characteristic especially in Southeast Asia now. I was in Thailand a couple of weeks ago, and it was fascinating to see luxury items right next to things that you wouldn't expect any other way. We met the head of Line Corporation's subsidiary in Thailand, and he pointed out that something like 2/3 of the 45 million people who have Line accounts there are paying their cell phones off every day. They're buying minutes every day. And he says, if you try to have a subscription-based service here, it won't work. So, you know, there's a lot of things to think about, how things are developing in these different countries. India GDP growth is noticeable, but I'm seeing a polarization of India into really two different systems. You've got the world-class information technology service providers, most of whom are making most of their money outside of India. And you've got the domestic economy where you have a lot of what's called frugal innovation. You have a lot of things that are really developing for the early stages of a developing economy. Increasingly, this ecosystem in Asia is separate and distinct from the rest of what we're used to. It's not something with the United States as a hub anymore. There are new supply chains that are servicing these new Asia consumer markets. And, you know, in the middle of this, China is really intentionally developing self-sufficiency across the board. Not only is it investing in artificial intelligence, but it's also investing a lot in the very basic components, computer chips. And it's developing at the other end new kinds of automobiles and may even actually be ahead of Western countries in autonomous driven vehicles in a few years. So, you know, Southeast Asia is no longer just the beginning stages of a supply chain that ends up in the US or Japan or Europe. You're seeing an awful lot of cross-border expansion inside Asia. After the US pulled out of the Trans-Pacific Partnership, it's been kept on as TPP-1, and China has its competing version of this free trade agreement called the RCEP. And you're also seeing the private sector doing a lot of things to expand across the region. Grab, I mentioned Line, visiting their Thailand offices. Gojek, Lazada. These are companies that have successfully become multinational in at least 6 or 7 different countries, a lot in Southeast Asia. So there's a lot of investment going on cross-border inside Asia. You're seeing unicorn creation across Asia. I'll talk a little bit more about that in the innovation section of the talk today. And Southeast Asia is the new battleground for influence. You see it on both sides. The Chinese government is using this Belt and Road Initiative. It's a way to project soft power, and it's a way to help its own domestic industries, and it's a way to fulfill what it sees as its appropriate place in the world order right now. And you know, a lot of the expansion going on by companies like Alibaba and Tencent are to reduce the influence of companies like Amazon in other parts of the world. So Uber had to sell its Southeast Asia business to Grab, but it did get some Grab stock as a result, so it's not like it completely lost out of the deal. Alibaba has bought 83% of the Singapore-based electronic commerce company Lazada that's in 6 different countries. And it has also invested over $1 billion in Tokopedia, which was a competitor to Lazada that's based in Indonesia. Expedia has led group kind of investment in Tokopedia, which is a travel site, kind of like Traveloka, I'm sorry, not Tokopedia, Traveloka, which is a travel site kind of like Expedia is itself, and Amazon started its Prime services in Singapore. Now, in the middle of this, you're seeing a lot of books about New World Order. Kai-Fu Lee just wrote one about AI superpowers, and he points out that it's a different type of expansion being done by American firms than are done by the Chinese firms. The Chinese firms tend to look for more local partners and tend to work really through their local partners more, while the American firms tend to just export their services over to the other country. A lot of people in China think that their approach will be more successful, one, because there's a lot of similarities in the purchasing behavior, in the consumer behavior of this emerging middle class in these different countries. And it's rather different from the old style middle class that you have in the old advanced economies. So another thing that I think is going on in general in Asia right now is that attention to social concerns is actually being turned from a problem into a huge opportunity area. So, especially in Japan and almost that much in South Korea and almost that much in China, people are really worried about the aging population. So guess what? There are hundreds of new companies that are being created around, things to make the situation better for people as they get older. You're seeing a lot of leapfrogging going on where even though the infrastructure that we have in advanced economies has not been developed, they will allow people in these emerging economies to have the same kind of services using their cell phone. So mobile banking is a lot further ahead in that part of the world than it is here. You're seeing a lot of attention being paid to the UN's Sustainable Development Goals. I can't tell you how many executives I run into Japan who have a little SDG lapel pin that they're wearing now. Another kind of driver is the shift to the digital economy. So even though you would think that there are not enough people who know how to do AI programming or other kinds of software programming, that would be a huge mistake. People are very quick to learn, and you're seeing serious technology plays coming out of places all across Asia. But there is still a lot of variation in the Asian economies, and to understand the dynamics of what people see as their competitive advantage, it's worth looking at what the World Economic Forum calls the 3 stages of economic development. So what we used to talk about as early stage developing economies, they call factor-driven economies. Typically in a factor-driven economy, the per person GDP or income, some people want to count income, some people want to count GDP. But it's below $15,000 a year. And in that kind of a setting, this is the situation where you're getting the first industrialization of the country. Socially, people start to flock to the cities. Hundreds of millions of people have moved into the cities in China over the last 25 years, and this is not stopping. This means that the business opportunities are everywhere. So why do you take the trouble to develop an advanced technology if you can make money with a simpler play? This is why people have kind of downplayed Chinese technology capabilities for too long. The business opportunities don't require it, and so, why take the extra risk? Getting there first to the market is by far a much more important competitive advantage. The government role at this stage is really basic laws, commercial code, propership, bankruptcy, all of this kind of stuff happens in this stage. The second stage is usually called efficiency driven. The first companies that have become successful during the first stage need to keep growing. And you will often have labor and capital shortages as a result. And so they tend to grow by globalization. They will grow the domestic markets as much as they can, and then they'll take the same thing and go overseas. We're seeing that in China now. We saw it in Korea in the early 1990s. We saw it in Japan from late 1970s. So this is a kind of thing that is a natural part of economic development, which means that the opportunities are scaling up, great quality, operational efficiency. And it's really at this stage that governments get real serious about intellectual property rights. As long as foreigners own all the intellectual property, no country is really going to care about it that much. But when you have domestic people who are having problems with intellectual property infringement, people get real serious real quick. The number of patent infringement cases in China is exploding. And interestingly enough, the foreigners who are bringing court cases in China now actually have a slightly better success ratio than do Chinese domestic companies, maybe because they're used to fighting that fight. But in any case, this is characteristic of the middle income level, the middle kind of stage of economic growth. This can be a very dangerous stage. It's been very dangerous in Japan and in South Korea because it's been hard to get out of. And I think one reason is that you learn how to be successful globalizing your company, expanding your company with great quality, with scaling up. All of those kinds of things require refining your business processes and being even more strict in how you maintain them. Unfortunately, for the next stage, what really matters is distinguishing yourself by having exactly right thing for the market even before the market knows it wants it. This is the innovation-driven stage of the economy, and companies kind of have to unlearn some of the things that they learned during the second stage. So wealth spreads throughout the population. Parents don't really want their kids to grow up and become line workers in a factory, even though one of the problems for economic structure is that at the second stage of an economy, there are a lot of really well-paying jobs that don't require more than a high school education. But people always give their kids a college education, and so the kids don't really want to deal with the old type of economy either. At this stage, the real competitive advantages have to do with understanding risk and being able to accommodate risk, not avoid it, but be able to deal with it in a very efficient way. How to keep high growth going. So, you know, if you're a startup company that wants to change the world and you have changed the world and become a big company, how do you keep up that high rate of growth? So that's what happens in the innovation-driven stage. And it's at this stage that the government starts to really worry about its startup sector of the economy. We've seen that here in the early 1980s with SBIR grants. You're seeing it now with similar kinds of programs in lots of Asian economies. So if you look at what's going around at some of these Asian economies, per person GDP in China right now is about $16,800. So it's clearly in the middle stage. It's in that efficiency-driven stage. And sure enough, you're seeing the big Chinese companies globalize. You're seeing a huge rise in venture capital, and you're seeing government support for R&D and really national infrastructure development that is looking ahead to the next stage. I will give this credit that it's very forward-looking to try to develop this, the capacity to be an innovation-driven economy instead of just making the money now and figuring it will happen later. In Japan, it's an innovation-driven economy, and you're seeing the startup ecosystem grow. We talked about that last week, but the big firms are still not able to benefit from the system like they do here. Just as a minor data point, exits by startup companies in the United States that are backed by venture capital tend to happen at a 10-to-1 ratio. 10 companies exit by being bought by big firms for every one company that exits by going IPO. And so that's an indication of how much the big companies are getting or trying to get value from the startup sector. Same kind of situation in South Korea. In fact, I could have really put those two into one row on this chart. With India, the per person GDP is still $7,100. That's a huge difference from even what you see in places like Indonesia now or other places. And so you do have these kind of two distinct systems that are growing up alongside each other. Some parts of India are very advanced economy. Other parts of India are very much, early stage, get there first kind of factor-driven economic development. In Singapore has a per-person GDP that's a lot higher than the US average and is actually pretty close to the Silicon Valley average. Silicon Valley incomes were somewhere around $95,000 to $110,000, depending on whether you live in San Francisco or down on the peninsula last year. So Singapore is really close to here, and sure enough, it's the financing hub for that entire region. In Indonesia, you've got an efficiency-driven economy that is the largest domestic market in the region. A lot of infrastructure plays are still rolling out, and a lot of big company plays are happening in Singapore. Singapore is also the location of 4 unicorns that were created in the last 10 years. And Indonesia was the location of 4 more. There's also 1 unicorn in Vietnam and 1 unicorn in one of the other Southeast Asian countries. Sorry. But in any case, you see that most of Southeast Asia tends to be at that level. And that's the trigger level where you start to see middle-class spending on things like automobiles, things like televisions. And so, yeah, this is why it's exciting to a lot of people. So let's get around to entrepreneurship. This was sort of general economic discussion, slanted toward entrepreneurship. But I want to start out by talking about data that is presented every year from a major consortium called the Global Entrepreneurship Monitor. They do a survey of almost 200,000 people worldwide every year. Now, this is run out of Babson College, which is famous for study of entrepreneurship, but they also have key partner universities around the world. And they use a local team in each country to do the surveying. We're going to look at their adult population survey, which minimum size of a good sample is 2,000 people. And they will not report the results for a year if they don't like the way the data was pulled. So, yeah, we're not going to use the second part of the survey, which is a survey of experts asking them for their really kind of subjective opinions about the ecosystem in that particular country. This is the 20th year that GEM has been in operation, and their online website is a great place to go for data. What I'm going to focus on is what they call the Total Early Stage Entrepreneurial Activity Index, also known as the T rate. And they've got a very clever definition for this because, as you know, there are a lot of really small businesses in any economy that don't kind of fit the model of startup we're talking about when we're studying entrepreneurship. So what they do is, in this T rate, they include people who are actively involved in setting up a business, or people who are managing a new business that have paid salaries for up to 3.5 years. Once you've paid salaries for more than 3.5 years, you fall out of the T rate. So if you look at how T rates tend to run, we talked about those 3 stages of an economy. The T rate in general tends to drop as an economy becomes more advanced. One reason is because in a developing economy, there are not as many salaried jobs in big companies that people could have. So more people are entrepreneurs because they have to be entrepreneurs. This is called necessity-driven entrepreneurship. If you divide it up between men and women, it's interesting that the T rate actually jumps up a little bit in the middle stage of the economy if you separate men and women out. That's very counterintuitive. But if you look at what's going on, you're seeing that it's pretty close to the sense of being necessity-driven. Women who are necessity-driven, they have to be an entrepreneur in order to eat, right? And it's not like they saw an opportunity they want to seize. There is no job available to them that they could take. That's actually the greatest participation is found at this middle stage of economic development. So that's the general trend in T rates and economies. The US T rate, sure enough, shows what goes on in the general economy. It dropped like a rock around the time of the last recession, and it's been going up steadily ever since then. So that we actually have a higher T rate in the United States than people do in China. So if you look at China, the T rate spiked in the year 2011, probably because of government official announcements supporting entrepreneurship, and then it's kind of been declining ever since then. Japan's T rate is very low, and if you look at India, India has had a kind of gradually maybe declining T rate. It's kind of hard to tell. In general, when you see a lot of yearly variation, it means that the economy is in some sort of a state of change. It means there's some sort of flux going on, and maybe structural changes is in the way. If you look at the tigers, the jumping off places to China, you see consistently lower T rates than the US, right? I kept the US T rate in gray so for your reference, but you see a gradual sort of increase in the amount of entrepreneurship in the economy. That reflects a shift in the type of entrepreneurship, that type of motivation people have for entrepreneurship. In the early stages, it was driven by necessity, but in the later stages, the more advanced stages of an economy, it's because people see the best opportunities. They don't want to just be earning a salary and not able to exercise their creativity. They see the possibility of making the world different. And so you see this kind of gradual increase over time since 2003. With Southeast Asia, you start out where everybody except Malaysia has a higher T rate than the US. That's not surprising since they are in this early middle stage of an economy, right? $12,000 to $16,000 a year of GDP per person. You see a lot of up and down, which to me says there's some sort of change going on, or possibly some sort of a sensitivity to external factors. I did put Thailand in here. So Thailand didn't even count 2010, but they had terrible floods there then. And a lot of things really went down in Thailand around the time of those floods. Malaysia was really depressed in a kind of unusual way, and I suspect it had to do with non-economic factors. I expect that it had to do with concern about the political system, and just recently, in the last couple of years, Malaysia has been extremely active. There's a group called the Malaysia Digital Economy Corporation, which is kind of a third sector public-private kind of thing. They have an office here in the US, and they bring groups of really interesting Malaysian startup companies to investors in Silicon Valley every year. Now, I think that given the amazing rise in GDP, it's sort of surprising that the T rates are gradually moving up instead of dropping more noticeably. I think the China slowdown maybe resulted, one, to the slowdown in the economy, and two, to the existence of more prestige jobs. BAT is starting to make it harder for people to hire good people in startup companies. Baidu, Alibaba, Tencent. And so that has, you know, kind of is an indication of major structural change and progress in China. There are some attitudes that may shed a little bit more light on this, though. First of all, the GEM survey takes all the people that did not fall into the T category. So these are the 13% in the US population in 2017, it was 15% last year, who were actively engaged in entrepreneurship. Of people who were not engaged in that kind of activity, of the working population, they asked them what kind of opportunities do they see for startup companies around them. So 63.5% of Americans saw good opportunities for starting up a company around them. 54% of non-entrepreneurs saw or thought that they had the ability to be a good entrepreneur. We're very confident. When you see the numbers in Asia, you realize that's a very high percentage. 33% of Americans were not starting a company, were not actively engaged in entrepreneurship because they were afraid of failing. Sometimes that's real economic fear, and sometimes it's social fear, but they're afraid of failing. And the other thing that they ask is, do you intend to become an entrepreneur to start a company in the next 3 years? So in the US, a few more people, 14.5% of the people they polled, said they were going to be an entrepreneur. And when you see this number, the intention number, considerably higher than the actual T rate, you can sort of assume that the T rate should expand from that point. So let's see what happens. In the United States, what has really happened over the last 20 years is everybody believes that opportunities for entrepreneurs are just fantastic. Most of these numbers are relatively flat. The actual T rate, the intention to start a new company rate really hasn't changed that much at all. There is a slight increase in the fear of failure, right? So that's a slight increase. There is pretty stable self-assessment of our abilities to be an entrepreneur. We're very confident people. But what has really changed is that everybody sees opportunities now. Well, think about it. How many universities now have training programs in entrepreneurship, right? Most of them started in the last 20 years. So this is, this is the baseline. Now, if you look at China, you see a very different kind of pattern. First of all, I mentioned this bump in 2011. Zoom, everything went up. Not only did the T rate itself go up, but the intention to start a company skyrocketed. It also dropped like a rock within a couple of years. But the T rate and the intention to start a company rate has an interesting gap of about 5%, which means that there's going to continue to be robust entrepreneur activities in the country. What I really see in this graph, and sure enough, there was a year or two when they wouldn't take the data. They didn't like the sample that they got from China. And there is a lot of up and down. But gradually, you see a kind of steady sense of maybe slightly increasing opportunities for entrepreneurs, but not a huge increase like we had in the United States over that same period of time. In contrast, what I'm seeing is a steady decline in the fear of failure and a pretty good, strong sense of perceived capabilities that's steady all the way across China. So it's a very entrepreneur-friendly environment. People have attitudes that, this is good, but maybe fear of failure is a little worse now because people do have more money than they did 20 years ago. That's not surprising. If you look at Thailand, Thailand is interesting because there is a huge gap between the actual T rate and the intention to be an entrepreneur rate, which may mean that a lot of people who say they intend to start a company never do. And I think one reason they don't is because Thailand has the highest fear of failure rate we've seen. Well over 50% of the population is not starting a company because they're afraid of failing. You see an increase in the perceived opportunities, maybe kind of sort of, is hard to tell because of the gaps in the graph. And you see not a bad sense of their self-assessment of their capabilities. But what really has happened is a super high fear of failure rate. And then you have Japan, right? So that the base rate for entrepreneurship, people who know Japan are extremely happy that it's gone up from about 1% to almost 5% for the T rate. But look how closely that tracks the intention to start a company in the next 3 years. You're not going to see a whole lot of change in this unless you start to see that intention thing track up more. To me, and of course the fear of failure is high, but it's not that high. If you were to compare this to Thailand, Thailand had a higher fear of failure rate than Japan did, and a much higher T rate. The huge barrier in Japan is that people do not see much good opportunities to start a company. And so that has to do maybe with funding. More likely it has to do with how hard it is to get a product to market. If you're doing a consumer play that's like an iPhone app, it's not that hard. But if you're in the business-to-business world, it's extremely hard to get a big company in Japan to give you the time of day. And so this is kind of the situation of what's going on there. But I don't want to be too negative. Last week, Tim, I thought, gave a very well thought out description of what's going on with the ecosystem around entrepreneurship in Japan. And I don't really have anything to take away from that, but I want to kind of put it in context of the whole region. So if you're looking at an innovation system, especially an entrepreneurial innovation system, you need to think about 3 elements. You need to think about people, you need to think about capital, and you need to think about ideas and knowledge. If you want to have a robust system of entrepreneurship, you not only have to have sources of those 3 elements, you also have to have dynamics that make it easy to flow into a new combination. Now this applies inside a big company as well as in a startup company. Inside a big company, you've got to get a budget for your R&D project. You have to do something with the intellectual property that you create, and you're going to get the basis for that from somewhere. So it does apply in a big company too, but it's really easy to see inside a startup company. Inside a startup company, the people will start by using their own capital. They'll use their own money to start the company off, and they will have to have the ability to use their own knowledge or ideas. If I invent something at Stanford and try to start a company around it, I have to buy the rights to my technology back from Stanford. That means I need capital, and I also need to acquire the right to use that knowledge in order to run my company. So different kinds of things play into that model at the different stages of company growth. At the startup, one of the main things to focus on in an entrepreneurship ecosystem is the presence or absence of angel investors, mainly as a source of money. With regard to people, you not only have the founders, but you have the people who will mentor the founders. That's a very important part of this system. And in regard to ideas and knowledge, they need to have access to R&D output. Design thinking is a technique that people use to come up with new ideas. Not only technology knowledge, but you also need market and business knowledge. You need to be able to get that somehow if you don't already have it. And of course, there's a need for infrastructure, both physical infrastructure and legal infrastructure, and also paid consultants who would never really become part of your team, but you may need to know what somebody will say about your market opportunity in order to get money. As the company gets started and as the company is growing, that's when venture capital funds come into play. At the very late stages of growth is where you get loans coming into play. The key things for people at that stage are not the entrepreneurs, it's the people who are willing to go to work in a startup company. And that has been largely ignored by almost every government program trying to support entrepreneurship in the world. These are the people who are forgotten. Employee number 15, right? And it's at this stage that you see things like lean startup principles and rapid prototyping. It's also at this stage where investor relations becomes a major thing that often leads to a company falling apart. And you need to be able to get to markets. You need legal and accounting, infrastructure, and so forth at that stage too. The exit stage is also a critical part of the ecosystem. Are there opportunities to go IPO, to be bought by a big firm? And once you do, is there a flexible labor market so that the people who are working in your company actually see being in your company as a positive step in their career, including you yourself, if you're the entrepreneur? In regard to the ideas and knowledge side of things, if a big company buys your firm, does that mean that your idea has just been killed? Sometimes big firms buy startup companies with that intention, but a lot of times they just don't do a very good job of taking the idea on to its full potential. And finally, you need bankruptcy law, you need transparent accounting principles and so forth for the companies to be sustainable after they've gone through that startup and growth phase. So, what's going on in Asia? Well, everywhere in the world, companies start with friends and family money. I don't think that's anything unique anywhere, and it's hard to get friends and family money in every part of the world. What's the real bottleneck in most Asian economies are angel investors who have startup company experience. Tim mentioned that very well last week in Japan. He said it's only been in the last couple of years that he's seen successful entrepreneurs turn into angel investors. Up until that point, they were, people who did personal investing in startup companies were people who had a lot of money, but they didn't know the world of entrepreneurship. Venture capital investments are the first thing that have really grown in Asia. There are some slowdowns. There's a downright flood of venture capital money in China right now. And yet, you have to say that a lot of the thinking of the venture capitalists is not really entrepreneur positive. It's bad enough here in the Valley. People talk about the dark side a lot. But in Asia, what you typically get are people who came from a financial institution or a consulting background. And so they don't really have the operational experience of running a startup company. And that makes them rather limited in their decision-making when they're on your board of directors. You do see Silicon Valley influence in Asia. There are a lot of initiatives by Silicon Valley investors, a lot of local investors. You look at their LinkedIn page and you find out they got an MBA from Stanford or from Wharton or from Berkeley or somewhere. The exit patterns are really different. As I mentioned, in the US, 90% of successful exits are by acquisition. In Asia, it's the flip. In Japan and in South Korea, 85 to 90% of all exits are going to be by IPO. And the amount of money that's raised in IPOs in Asia is much smaller than the average deal size in the US. Now, that's different in China. China has reached a point where the average IPO size in China is very similar to the average IPO size in the United States. But I haven't been able to look at what percentage of shares of stock the entrepreneur keeps in Asia. If you keep too much, the company is still your own company, even though it's a public company, and that's kind of, there's a problem there. So here's how venture capital has grown in China over the last 10 years. This only went up through the first half of 2018. But in the first half of 2018, the amount of venture capital invested in China actually exceeded the amount of venture capital invested in the United States. Now, what happened with the US graph for the second half of the year is that it bounced all the way up to $130 billion. That's more money invested in venture capital even than was invested during the dot-com boom of 1999. But I'm not sure just how far China went, but I think it went to like 80 billion. It may not have exceeded this huge amount in the US, but you can see the rise of the red bars. I mean, it's definitely on par with the United States at this point. But if you look at the number of deals, you see something interesting. Now, I could find this. This is not just China. This is all of Asia and Europe, right? So in terms of the money raised, we saw this similar thing to what was shown in the previous slide. So a lot of this is China, right, in terms of the amount of venture capital invested. But in terms of the number of deals, notice that the bars, the graph does not slope nearly as steeply up. There are fewer deals for a larger amount of money, which means that the average deal size is a lot bigger in Asia now. What's going on? The flip side of this is if you look at the Silicon Valley statistics, the amount of angel funding in Silicon Valley last year for the last 4 years has been dropping dramatically. Bigger deals. People are moving to later stage deals. They get their money quicker and they have less risk, and they have developed the financial kind of expert knowledge to be able to do late stage investments in a way that's very competitive. So I think in Asia as well, you see the kind of financial backgrounds of a lot of the venture capital investors. So mega rounds, a round of funding that raised more than $100 million. This is worldwide statistics, went up from about 50 in the year 2013 to 382 in the year 2018. There's another chart that I didn't put into this presentation that shows what percentage of funding is going into seed and what percentage of funding is going into Series A, what percentage of funding is going into this giant, pre-IPO stage. And the percentage of money going into seed and Series A is shrinking. So that you're really, if you have a unicorn in the making, you're in great shape, but it's actually harder to get first funding now than it was. On the exit side, on the US, sure enough, here's over the last, 7 or 8 years, you can see that the number of exits by strategic M&A and also buyout for a distressed company was even more than 10 to 1, right? 711 exits by acquisition and 58 exits by IPO. You also see that the US companies raised about a similar kind of ratio of money in the acquisition as they did in the IPO. The IPOs, for the number of IPOs, raised a little bit more money than was raised by the acquisitions. But when you look at that same pattern in Asia, you see much more IPOs that raised almost minuscule amounts of money. So that's what I mean by the small IPO size in Asia typically leads to a company that's really not strong enough to stand the pressures of the public market. And that's going to be a dangerous thing over the long term. Now, venture capital in other countries, Tim talked a little bit about venture capital in Japan. He cited $2.5 billion for 2017. The estimates I've seen for 2018 are $3.8 billion. Now, right, $130 billion in the United States and $3.8 billion in Japan, which has about half the population of the United States. So one big difference between the way VC works in Japan and in the US, corporate venture capital is participating in about 30% of all the venture capital deals in the US. It's the flip in Japan. It is involved in at least 70% of all of the venture capital deals in Japan. But as Japanese company after company creates venture capital groups, it's remarkable that more than half of their investments are going to outside Japan. So the Japanese companies are here. They are sending groups over to Israel every year, and they are looking around Europe. They're looking pretty much worldwide for good investment opportunities. Korea has an even smaller venture capital. South Korea has an even smaller venture capital industry. What's really distinctive about Korea is that the South Korean government has decided to kickstart this. They've created something that people, I hear, call the mother fund. And basically, the venture capitalist applies to leverage the venture capitalist investment with additional money from the government. So there's a $3 billion fund in existence now, and they're planning to increase it by $9 billion, kind of sort of by this year. But everybody says that it's incredibly painful to try to use. It's government money. What do you expect? So I think that This is something where South Korea is still on the emerging side. You do see the big companies being very active in M&A and corporate venture capital, but they are not really, I didn't finish that sentence, they're not really able to benefit that much from what the startup companies are doing. At least I haven't seen a major big win. I've seen a lot of good, interesting things. We had Samsung's innovation group was investing in a smart lock company here, and they were doing really good business. But it's not like the next Uber. Anyway, that's what's going on in those two other countries. If you look at Southeast Asia, you see a huge increase in the number of deals. If you look at the amount of money, it's an even sharper increase. And notice that more than half of the deals are being done in Singapore. And Indonesia is really coming up there in strong number 2. So you're seeing, a rapid rise in venture capital. I'm seeing a lot of cross-border investment in VC funds that are focused on Southeast Asia. Golden Gate Ventures has just raised a round of about 150 or 200 million with funding from all sorts of life insurance companies and other groups all around Asia. And so, it's up and coming. One kind of I thought an interesting summation of what the situation for venture capital in Asia is in this chart. So this is the growth in deal value, and granted it's a few years old, and this is the growth in deal volume. So Southeast Asia has very high growth both in the number of deals and in the value of the deals, whereas China and India are kind of right in the middle. The deal value is growing a lot and deal volume is growing some. And then you have less growth in the advanced economies because they're already so big. Really, how much venture capital can an economy take? People flow. There are entrepreneurs everywhere, even in places where the T rate is very low. The growth stage is the real problem. It's hard to get good people to come to work for a startup company. And part of this is that the incentivization schemes are not very sophisticated in Asia. Entrepreneurs don't like to use their hard-earned investment money to pay high salaries. And stock options are still much less a part of the deal than they are here. And you're seeing some of the big firms siphoning off good workers. I give a hard time to BAT, but I would dare say that Grab and Line and these companies down in Southeast Asia are pulling in an awful lot of people who could be in startup companies otherwise. There's a huge social stigma. And it's not only the fear of failure. I think those charts that I showed from the GEM report really show that it's the perception of a lack of opportunity that's the real thing that's keeping people away from the startup sector. And some countries have very sticky employment relations. Japan called it lifetime employment, right? That is a disincentive to going to work for a startup company because the chances that you will stay your entire career with that same startup company are like close to zero. The entrepreneurs who stay with their company after exit may not be the best managers of a sustainable company. That's where you have to get away from your original idea and figure out how to keep growing the company even after your first product idea is gone. So that kind of lack of mobility can be a problem. With idea and knowledge flow, all over the region, there are hundreds of millions of dollars going into tech transfer programs to get more IP out of universities and research institutions. What they're not getting is business knowledge. That's a real lack in, a problem in this whole innovation system. Innovation is not just the technology, it really requires business knowledge. And in that regard, mentoring is not really so well developed in Asia. Most university professors in Asia make terrible mentors because they're not willing to take a risk. Because my status, if I told you something that could be at all incorrect, would just be horrible, right? I mean, I'd have to go out and kill myself or something. And I think that you tend to have less confrontational board meetings in Asia. How else did Carlos go and keep doing all the things that he was doing with the board of directors and Nissan not paying attention? It may be difficult in Asian cultures because of Confucian traditions of apprenticeship. The model for education in Asia is not based on the same model we're using in the West. Here we base education on Platonic dialogue. I argue with you and we both learn. In Asia, you imitate the master, which is a great way to internalize what the master knows, but you don't talk about it. And so because it's a violation of face considerations to say why you screwed up, a lot of times you don't have the analysis of failure that's really the strength of Silicon Valley. Silicon Valley doesn't allow failure. Silicon Valley analyzes it and recycles what can be recycled very well. So the startup companies really do have a hard time getting to market just about everywhere except in China. And I think it's going to get harder in China as the big companies become more established. And the failure of open innovation systems where the big companies really don't know how to cooperate with startups. They tend to think of outsourcing relationships, and they don't really understand the value of working with people whose technology is not perfect yet. People whose business idea may change next month. That kind of flexibility is hard in a big company anyway. The companies here in the Valley are probably better than anywhere else in the world at doing that. So there are robust systems to support entrepreneurs in Asia, throughout Asia. The attitudes and opportunities for entrepreneurs reveal the way that the ecosystems are developing. There's a huge amount of variety. One of the hardest things about giving this talk is to lump Asia together when there's so much difference from country to country in Asia, much more than there are differences even between the EU countries. You still see some ecosystem weaknesses that we've talked about. I think what's really noticeable this year, this is the mega deals. And I'm not sure that unicorn counting is really that good a pastime. There's somewhere between 390 and 450 unicorns in the world. About half of them are in the United States. About 100 of them are in China. There are 10 of them in Southeast Asia, according to one source that I saw. And they're expecting another 10 within the next 5 years in Southeast Asia. There is one in Japan. Used to be 2, but the company went public, so it shouldn't be called a unicorn anymore. And what I'm kind of concerned with is that unicorn status allows you not to get your company ready for the public market. It allows you to keep going on this kind of quasi-startup footing where you don't have the excellent business practices, you don't have the transparency that eventually you will need. If those relationships become too sticky, I'm kind of afraid that we might be recreating the business groups in Japan or South Korea, right? The chaebol in South Korea or the keiretsu in Japan, because there will be a lot of cross-shareholding of stock, a lot of long-term shareholding of stock that's not going to go anywhere on the public market, so valuations become questionable. This is a topic that I think really bears watching, and I'm hoping to devote some more time in the series to it. And finally, the US-China friction is a real wild card. I think that we need good positive presence. Silicon Valley has depended on world markets since about 1980. And so we really need to have a good environment for global knowledge. We're going to be involved in global competition, so being involved in global cooperation where we can is a good thing. And I'm really not sure where this is going to play out. It's a lot deeper than trade problems. It has to do with national security issues. It does have to do with a particular type of government-industry relationships that would not be possible here. And so that's a wild card. We need to watch that for this year. On that kind of depressing note, that's the end of my prepared comments. We've got some time for question and answer. Thank you very much for your attention.